There are thousands of indicators out there, in every color and every complicated formula you can imagine. Some make your chart look like a rainbow, others look more like a math maze than a trading tool. But the truth is, only a handful of them can actually help you make consistent profits. And the stochastic oscillator is one of those few. If you're looking for an indicator that can read momentum, predict reversals, and confirm trends, then this video is exactly for you. I'm Louise, your AI trading assistant, and today I'm going to show you the most powerful stochastic strategies that top traders use every single day. Trust me, once you understand it, you'll never again sell just because it looks overbought, and then sit there watching price rocket higher like a SpaceX launch. The stochastic oscillator measures where the closing price sits relative to its recent high and low range. It tells you where the market stands in terms of momentum. It has two lines, the %K line, which is the main line, and the %D line, which is a moving average of %K. These two lines act like a language that reveals whether the market is strong or weak. There are two versions most traders know about. The fast stochastic reacts quickly and throws out many signals, but it comes with plenty of noise and false triggers. To deal with that, the slow stochastic was created, smoothing out the signals and filtering unnecessary noise. This is why the slow version has become the standard for professional traders. A classic mistake traders make is to apply the textbook rule that says you sell whenever the oscillator goes above 80 and buy when it drops below 20. This approach only works in a sideways market. In a trending market, selling above 80 is like trying to stop a moving train. You'll get run over. Stochastic doesn't measure overbought or oversold. It measures momentum. When it stays above 80, it doesn't mean the trend is about to collapse. It means momentum is extremely strong, and the trend can last much longer than expected. This is why reading stochastic correctly requires context. In a ranging market, crossovers are reliable. In a trending market, you have to completely change your approach. That is the line that separates beginners from professional traders. The most basic use of stochastic is the crossover. When %K crosses above %D at lower levels, traders see it as a buy signal. When %K drops below %D at higher levels, it becomes a sell signal. In sideways markets, this method works fairly well, often producing accurate short-term trades. But in strong trends, the rules change. You don't trade every crossover. You only take buy crossovers in an uptrend, and you only take sell crossovers in a downtrend. By filtering the signals this way, you avoid most false trades and focus only on the moves that align with the dominant trend. This adjustment alone transforms the effectiveness of the strategy. Another powerful application is divergence. Divergence happens when the price and the oscillator disagree. For example, price creates a higher high while stochastic creates a lower high. That signals weakening momentum and often precedes a reversal. Conversely, price makes a lower low while stochastic makes a higher low, which means selling pressure is fading and a bounce could follow. Aussie traders only pay attention to the 20 and 80 levels, but there's another line that can be extremely powerful, the 50 level. When stochastic crosses above 50, it confirms buying pressure is taking control. When it crosses below 50, selling pressure dominates. The 50 level acts as a momentum filter. It helps you avoid false signals in sideways conditions and keeps you disciplined. If you combine the 50 level with support and resistance zones or moving averages, you get a highly reliable confirmation tool. Many experienced traders prefer this because it simplifies their system while keeping accuracy high. Let's bring this into practice with XAUSD. In the first case, the market is trending upward and breaks through resistance. Stochastic is above 80. An amateur trader might scream, "Overbought," and jump into a short, only to watch price continue climbing for hundreds of pips while their account burns. A professional reads it differently. They don't short the move. They wait for a buy crossover within the uptrend. Instead of being trapped, they ride the entire wave upward. In the second case, we see regular divergence. Price forms a higher high, but stochastic prints a lower high. This indicates momentum is weakening. If this happens right at a strong resistance level, it provides a golden short entry before the reversal begins. And finally, the 50 level proves its worth in sideways markets. Rather than getting distracted by endless false signals around 20 and 80, you simply focus on the 50 line. If stochastic stays above 50, you stick with buy trades. If it drops below, you stick with sells. This keeps your system clean and your trades disciplined. So remember this: use crossovers with the trend, rely on divergences and hidden divergences to spot high probability setups. Pay attention to the 50 line as a momentum filter, and always confirm with price action or moving averages. Once you master stochastic, you'll see trading differently. Your entries will be more confident, your exits more precise, and your profits more consistent. If you found this video helpful, make sure to hit like, subscribe to Zeus Trading Cashback, and join our group in the description to access real-time signals along with cashback on your trades. Right now, we're offering a free 7-day trial of our premium group so you can test professional strategies without paying a cent. Don't miss it, because this could be the turning point in your trading journey. I'll see you in the next video.